is weaker over the last couple of days, and the market has rallied. When it strengthened, those investors globally, or even sovereign countries that are looking for U.S. dollars, sell their U.S. dollar assets, and that puts more downward pressure on equity markets here.
Is that durable market pressure, durable downward pressure, or something that exhausts itself pretty quickly?
Well, it depends. I mean, has the dollar peaked here? I don't know. I certainly don't think rates have peaked. I would not be long duration here. I wouldn't be long duration equity, long duration equity holdings as well. So when I look at the broader market, I see, the dollar weakening temporarily, and quite frankly, we're positioned, in the energy space and the commodity space for the coming months.
Patrick, I'll pick up on the commodity story in just a moment. With regards to the bond market, that judgment call you just made, what are the assumptions that underpin that?
On the rate market?
Yeah, that we haven't seen peak yields.
Yeah, so when I look at broader commodities, again, right now we're in a supply-constrained market. So I continue to see, we heard OPEC, they're going to be speaking tomorrow. They're going to look to cut roughly 1 million barrels per day. So that's going to continue to support energy. When we look at gold, again, just look at the dollar being down roughly 15% through today. Gold is down roughly 6%. On the year, I actually think gold has held up pretty well. If you look at gold in yen terms, if you look at gold in euro terms, it's held up well. It's done its job. It's really provided a hedge against, the risk of, fiat currency debasement. So we still continue to like gold exposure here.
Patrick, I wanted to talk to you about cyclical exposure as well.
Yeah.
Still like energy, you like the rails. I understand from the rails perspective, there's more of a long-term story underpinning that, but talk to me about how you want to add cyclicality at the moment.
Yeah, so the rail space is sort of a good example of the fact that right now we're in a time where we're deglobalizing, right? So when we think of structural inflation, we look at deglobalization, we look at sort of demographics and the labor market, right? So who's going to benefit? So just look to a country like Mexico. They can still produce cheaply. So owning a Class 1 rail, like, say, for example, Canadian Pacific, they have rail lines all the way from Mexico up to Canada now after, their acquisition of Kansas City Southern. So we like that space. There's been a lot of consolidation in that space over the last decade. They're getting pricing power. It's an onshoring play, and they can move a lot more material, cargo, et cetera, using a lot while burning a lot less carbon. So I think it has a lot of structural advantages over the next 10 years.
And Patrick, what would you say back to people who say, why would I want to buy it here? I get the long-term story, I get all of that, but why would I want to buy it here before we've seen the economic downturn really gain momentum?
Yeah, because quite honestly, I don't think they're as, I think they're actually a little more defensive than people think. We're going to continue to move product, across different sectors. And again, when you have this onshoring play, that's a bullish tailwind. And then, you fold that into, compare that, dovetail that with where valuations are today, I think it's a very attractive situation.
We'll return to that call before the end of the year, no doubt. Patrick, thank you. Patrick Frassetti there on the rails there, and where he's optimistic, more constructive on this equity market. Up next on this program, Meta dialing back growth plans in New York City as corporate America turns to hiring freezes.
The hiring freezes and the trading down to a lower level are appropriate. I think there's probably some concern in Q1 of next year. So I think we're kind of showing that things are slowing down. Order books are still not too bad, but clearly Q1 is a concern.
That conversation up next.
hiring freezes and the attriting down to a lower level are appropriate. I think there's probably some concern in Q1 of next year. Nobody ever wants to lay people off in the Thanksgiving, Christmas holiday period, and you really can't do a layoff till late January. So I think we're kind of showing that things are slowing down. Order books are still not too bad, but clearly Q1 is a concern.
Softer manufacturing data, softer than expected yesterday. The weakness starting to creep in. We're seeing it in corporate America as well. Meta closing one of its New York offices with more cutbacks looming. A spokesperson saying the following: "We are working to ensure we're making focused, balanced investments to support our most strategic long-term priorities." Taylor, that corporate speak drives me nuts. What's the latest?
I know, and I hear you, John, and I think the comments from Zuckerberg last week were really interesting, saying that he's looking at a company in 2023 that actually might be smaller than it is today. And you see that maybe coming from the pressure on top line growth, as you have a company that's looking at what could be a 4%, maybe a 1% decline year over year in this quarter, and then that drops as much as maybe 5% on a year over year drop in sales and revenue next quarter. That might be peak, as then the company rebounds a little bit, but then still looking in the fourth quarter at what could be still a decline on top line growth year over year of about 3%. So all of those headwinds then lead into a company that's looking at maybe job openings that are easing, with the companies saying not layoffs, but maybe hiring freezes, and indeed pulling back on some of the New York City offices that I know that we had a great story out this morning talking about that, and just sort of rethinking, as you mentioned, some of those long-term priorities and balancing the investment versus the growth.
Taylor, thank you. I think the phrase Taylor used then is really important. Hiring freezes, not layoffs. And a line we've talked about repeatedly over the last couple of weeks is that you can't fire what you could not hire. So we're going to see this show up in jobless claims or show up in JOLTS, job openings. Job openings coming out a little bit later, and arguably that's what the Fed is shooting for, to get job openings lower without really taking a big chunk out of the labour market. Mary Daly speaking right now of the San Francisco Fed and saying the following: inflation has not gotten into the psychology of Americans. I guess that's the good news for them. Sees a lot of room to slow the labour market. That's what she's speaking to. Looking abroad as well, not just domestically, saying the following: the Fed is aware its moves affect the global economy. The global economy is having a tougher and tougher time of it. Can you imagine trying to put together a strategic reorg in a world like this one? Credit Suisse rebounding this morning from a record low. The spotlight on the company's restructuring plans amid concerns over financial health. On top of this story for us has been Bloomberg's Sonali Basak. Morning, Sonali.
Good morning, John. You're looking at Credit Suisse ADRs yesterday closing above where they closed Friday, and you're watching the shares also close higher in Switzerland. So yesterday was a bit of a blip in the radar, but that does not ease many concerns still on the horizon. There's a lot of calls here from Wall Street sell side on whether they should be moving up their strategy review, the announcement that they're supposed to be making at the end of October, because the stock is trading something close to a meme stock until then. If you take a look online, it's kind of incredible. You're watching crypto traders looking to buy Credit Suisse at its low. But at the same time, there's a lot of struggles ahead, and Bloomberg's Allison Williams pointed it out very craftfully, which is that until you have a sense of what a potential capital raise could look like, it's very difficult to figure out what that stock is worth today, because such an event could be quite dilutive. Listen, Credit Suisse is really trying to pull a Deutsche Bank here, potentially sell some assets, get rid of some businesses to help fill that gap in that capital raise. But let's play investment banker here for just a second, because it's not where Deutsche Bank was just a couple of years ago, where the market was still soaring high. Selling assets at these levels will be lower than whether if they started to sell just a year ago. They also have to drum up demand. And right now, a lot of firms are very reticent to take on risky assets. So the types of deal making Credit Suisse could make in this environment could have to get very creative here to start filling that what analysts think is a $4 billion hole that they'll need to fund this restructuring.
Sonali, I think you framed it perfectly. Just nailed it. This is going to be difficult to achieve. What's frustrated me when it comes to the likes of Credit Suisse, the likes of Deutsche Bank, and I wonder if it frustrates you, that we keep benchmarking to Lehman, that it's either Lehman or it's okay. And there is something in between here, Sonali, and it's still not great.
If for no other reason than that these firms have become semi-utilities since then, right? They have the full faith of the governments behind them. But beyond that, John, you have this firm trading at, less than a fourth of its book value. Take a look across the European banking sector. Most of these firms are burning money and are also trading below their book value pretty steeply, and I think that's a pretty remarkable event to face.
Sonali, thank you. Looking forward to your coverage, as I've said repeatedly, through the next several weeks on this, into the end of the month when we expect wait to hear that strategic reorg, that big plan from Credit Suisse, and then in a few weeks' time you'll hear from JP Morgan and we'll kick off earnings season as well. Equities right now up 2.4% on the S&P 500. Yields were much lower. I have to say that story's faded. The 10-year basically unchanged at 363. The 2-year, big move lower yesterday by about 17 basis points off the back of the ISM manufacturing number that came in a bit softer. A lot more going on than just that. 4.1% on a 2-year this morning. We're down about 2 basis points. Want to get you some sector price action, lift the lid on the equity market with more. Here's Katie.
Well, John, literally everything is in the green. That is true on a sector level and on an individual mover basis. There's only right now 3 stocks in the S&P 500 that are not in positive territory on the day. So no surprise when you look at the IMAP function on the Bloomberg, everything is gaining to the tune of 1.5% or more. And of course, you see at the top there some of those rate sensitive sectors still outperforming, even though we have seen things turn around in the bond market. The likes of financials up about 3%. Consumer discretionary also higher by more than 3%. Of course, big weightings in that index include Amazon and Tesla, some big tech names that are seeing some big gains today. When you take a look even further beneath the surface at some of the more isolated sectors as well, consumer finance, this of course has a rate sensitivity factor when it comes to mortgages. If mortgage rates aren't extraordinarily high, you may have more people looking to take out loans and buy a home. So that's feeding through to names like Zillow, higher by about 4% with about 20 minutes into the trading day. And then you also have some internet retailers higher as well. Part of this is idiosyncratic, the story with Poshmark being bought by a Korean rival for $1.2 billion. But part of it as well is just the broader risk rally we are seeing, the idea that if borrowing costs aren't as high, people may have more money to spend. So you're seeing Wayfair up about 7.4% as well. But again, John, now looking at the moves in the S&P 500, just one stock is in negative territory on the day, and that would be Dollar General.
There we go. I think that speaks volumes at the moment we're in. At the moment, at least. Let's see how long it lasts. Katie, thank you. This from Mary Daly, the San Francisco Fed president. A narrow path to a soft landing, but it's not closed. Every time we get a rally, we end up having the same conversation. A Fed pivot. The S&P 500 up 2.4%, the Nasdaq up 2.8%. And to be fair, if you compare where we're priced on the terminal rate now compared to last week, we've come in about 30 basis points. That's material. That speaks to the readjustment in the equity market. Whether the Fed's going to pivot or not is a separate debate, and whether the Fed is pivoting for bullish reasons is a very different conversation as well. Up next, the trading diary from New York. This is Bloomberg.
The reality is, though, that interest rates are set by the Independent Bank of England, They make those decisions on the basis of what's happening with inflation and other factors. The energy intervention that we have done is likely to curb inflation by up to 5 points, so that has a positive effect. But ultimately what we're seeing around the world in the wake of Putin's war in Ukraine is interest rates rise. So the Federal Reserve, for example, has pushed up interest rates. So we will do what we can to support people, but ultimately it is a decision for the Independent Bank of England.
Of course, the first mission of the new management of EDF, Luc Rémont will be at the head of EDF, is to have those 12 nuclear plants being reopened as soon as possible. I mean, by the beginning of 2023, we want all these 12 nuclear plants being reopened, because there is a need for nuclear plants and there is a need for nuclear electricity.
It's a difficult time in Europe, and it might not be just for one winter. It could continue for a number of years. Speaking to a number of energy experts. Equities right now up 2.3%. The gains continue on the S&P, on the Nasdaq 100 up by 2.6. The gains continue even as the move in the bond market fades. 2s, 10s and 30s yields were so much lower. Now basically unchanged on a 10-year, 363.49. Your 2-year, 4.1%. With that in mind, we'll see if these equities gains stick, if that bond market carries on moving in this direction. That's the price action. Here's your trading diary. First up, durable goods and jolts. Coming up the top of the hour, President Biden delivering remarks at 3 p.m. Eastern. Busy stretch of Fed speak continuing with Daly again this afternoon, followed by Bostic on Wednesday, plus OPEC meeting in Vienna. And finally, the US payrolls report is coming up on Friday. I can tell you the estimate right now on payrolls, 265 in our survey, down from about 315. From New York, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
the financial centers of the world. This is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day on this Tuesday, October 4th. Here are the top market stories that we're following for you at this hour. The one with the pivot. The RBA, the first central bank to back off outside rate hikes, adding chatter to a market looking for something similar from the Fed. Plus, keep on charge and equity bulls come running back for a second day. We're going to break that down with David Kostin, Goldman Sachs chief U.S. equity strategist. And jobs, jobs, jobs. We get a first peek at what to expect from payrolls data this Friday as investors look to JOLTS numbers out momentarily for any signs of a cooling labor market. From New York, I'm Alex Steele, my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. It's worth bearing in mind, despite the fact we're seeing this monster rally for a second day, that there's a lot of ground to still be made up.
Absolutely, yeah. You need to put this all into perspective. But we're seeing a really big rally on equities here in Europe. I'm blaming the Australians for most of what we're seeing in the market today. But I think the ISM data yesterday does kind of play its part. And I wonder whether the JOLTS number will be about to contribute as well. Because you were talking about the employment story, Alex, and we're getting the JOLTS number, 10 million. Almost on the nose. That is significantly short of the 11 million that the market was looking for. There's a number of ways of spinning this, okay? And we'll go through the other data in a moment, which looks significantly less exciting. But you could spin this that this is a labour market that is slowing. You could spin this that this is employers pulling back a little bit, or they can't find the staff. So there's another way of spinning it as well. But the question is, will the market spin this as bad news as good news? And I think that's the debate.
Yep, and we also just heard from Mary Daly. She was talking on CNN saying that there is still a lot of room to slow the labour market, a.k.a. they're not done yet. Equities, though, ignoring that. The S&P now around the highs of the session of 2.8%. That echoes the ISM manufacturing reaction yesterday, the bad news, good news situation.
Absolutely. Massive move in the bond market, though, over the last 24 hours. And as I say, you can pretty much blame the Australians for this. And our question of the day is seen, therefore, through the filter of friends. I've seen this on Twitter time after time after time. The episode, I think it's the one with the cop, actually, where they're trying to get a sofa up the stairwell, and it's pivot, pivot, pivot. And there's a heated debate on Wall Street about this right now, Alex. Is the Fed going to pivot? Are we seeing early signs of that? I have to say the Fed speak certainly doesn't speak to it, but maybe the data does. I don't know. What do you think? This was your question of the day, after all.
It wasn't. Mine was pivot. This was our producer, John Hyland, came up with the Friends reference, and Guy and I are both big Friends fans, so we were really excited about it. But the idea percolating in the market that at some point will we see it? Will financial instability become so much that price stability kind of get kicked out a little bit? So let's kick that around. Michael McKee, Bloomberg International Economics and Policy Correspondent, and Bloomberg's Christina Aquino joins us now. Mike, this is what the market seems to be in some point hoping / betting / bad news is good news. Is this the one where the Fed pivots?
If only I wish were father to the man. No, not yet. The JOLTS numbers are 2 months old, of course. This is August data. And so it's not telling us anything about what's happening right now in the economy. But if the trend were to continue, it would probably be good news. But you can see the difference between job openings and the job openings and hires. There's still a big gap there that they have to fill in. And until they do that, the Fed is going to continue to make the argument that the labor market is tight, and therefore they need to take action because people are getting paid more, and that is inflationary. We do have a jobs report on Friday. That might be the day you're looking for, or next week when we get the CPI, but it isn't today.
It's interesting, European stocks, we're nearly up by 4% right now. The Euro stocks up by 3.79%. Christine, let me throw this to you. Is this the one where the Fed pivots, or is this the one where the Australians basically end up looking like they're out of whack with everybody else? Because the 25 bips from the RBA overnight does look inconsistent with the message we're getting from other central banks.
Well, look, say what you will about the Australians, but a lot of the time, maybe tell me later, but a lot of the time they have proven to be quite the bellwether for global trends, right? And that is because Australia is a small, open economy. They are exposed to what's happening in global growth, global inflation, inflation, but then also with an eye on China, which is their biggest trading partner. And so it is actually representative of a lot of the cross currents in what's happening globally. And, you know, the Fed in the U.S. economy is one thing, but as far as kind of being a representative of the impact globally of what we're seeing in the U.S., Australia is actually a really good representative. And so I wouldn't be surprised if we kind of see some version of various central banks starting to consider thinking about pivoting. Maybe not actually pivoting, but at least going the way of Australia in starting that thought process now.
Well, and then also to that point, pivoting doesn't mean necessarily stop hiking or cutting, which is I feel like what a pivot represented for the market, say 3 months ago. It feels like now pivoting just means like no longer 75 bips of a hike in one meeting, like we're back to 50, maybe 25, Christine.
Absolutely, Alex. And I think that is the nuance that's important to note in the message from the RBA overnight as well, is that they're not in any shape or form stopping the hiking cycle. They're just kind of thinking about maybe smaller increments moving forward as they kind of figure out how what they've done so far is working its way through the economy. And I would say the same thing of the Fed as well as far as market expectations go, right? I mean, it's not that the markets are stopping those expectations, those bets for the Fed rate to rise. It's just that maybe it's a little lower of a peak or maybe earlier of a peak. I mean, at the moment, I think we're seeing less of a peak now around March 2023. And so that would be where you watch the nuance in terms of changing market expectations as far as the Fed action goes.
Mike, I hear what you're saying about the JOLTS number being a rearview mirror number, but if the labor market is front and center, the market is taking this as being a negative for the U.S. economy. There are signs that the labor market is starting to cool off, and that would be a big piece in the puzzle if we were to think about what it would take for the Fed to form a fully sort of complete picture of wanting to change policy, or not change policy, but slow policy. If we get a big, what would it take on Friday to be consistent with that JOLTS number, and what would it take for the Fed to react to that Friday week number?
I think if you got 260, 265, which is the Bloomberg consensus forecast, that tells the Fed that hiring is slowing down. If we should see a rise in the unemployment rate, that would also be part of that picture. And then the Fed may start to reconsider. But remember, they only a month ago put out the message that they're going another 125 basis points this year. And so they're probably not going to want to reverse very quickly unless the data tell them that the things are all clear. If we got a really bad jobs report, the Fed probably would back off, and you'd start hearing that in their speeches. But then the inflation number is going to be the all-important one. One big difference between us and Australia is we have 8% inflation. Europe has 9% to 10% inflation. Australia is at 6%.
When 6% inflation is actually good. There you go. Hey, Mike, but to that point, and I think this is where it gets really tricky because the markets is going to front run any of this. So the market is already front running what they think the Fed's going to have to do, which means that then the Fed can't do it because all of a sudden you're going to have financial conditions loosen because now yields are lower, dollars lower, and equities are up.
Well, I don't want to be too snarky, but if we got a 500,000, if we got a 500,000 jobs report on Friday, hold my beer. You know, the market will change its mind again. The markets are going up and down quite a bit based on the individual data points. They're trying to put together a whole picture. The Fed's trying to put together a whole picture. If you're trading, you've got to do something now. The Fed doesn't have to do anything until November 2nd. And so they're going to wait and watch the data come in and see if they need to move. They don't have to position themselves for the markets. The markets position themselves for the Fed. So at this point, it's kind of hard to say that the Fed is going to have to do what the markets want when we're still a month away.
Where does this leave the ECB, Christine? Where does this leave the Bank of England? The Bank of England has got a number of different challenges that it's got to kind of deal with right now. Clearly, the mini-budget has upset the apple cart quite significantly, but the market's beginning to price out some of the very aggressive rate hikes that we had put in over the last few days. The ECB's also got a significant problem as well, and that is the emergence of increasingly sticky inflation in the Eurozone. And I'm wondering whether or not actually you could find yourself in a situation where the Fed maybe changes direction, but Europe needs to keep going.
Yeah, well, that is quite the dilemma for the ECB, isn't it, Guy? Because at the same time, I mean, you're absolutely right. They are dealing with more sticky inflation, higher levels of absolute levels of inflation, but also there's the fragmentation issue that Christine Lagarde and her colleagues are very, very worried about, as we can tell from their actions over the summer. And that's something that it seems is quite a big priority for them. While inflation, yes, is kind of the bigger counterweight to all of this at the moment, I could see the balance easily shifting to thinking about the impacts of fragmentation and also how the weaker links in the Eurozone will react to all of this.
Alex, I think she speaks at the top of the next hour as well, so I think this could be fascinating to hear what she has to say. I think she's down in Cyprus, so maybe we'll get an update from Lagarde shortly.
Yeah, wouldn't that be nice? Clarity, huh? What? Christine, but I think that you bring up a really good point, too, that we could be in a world where we see central banks continuing to hike rates in some form, but still have to do some form of QE on the long end. I mean, it's PEP with the ECB. It's short-term, long-term bond buying to help UK pension funds over at the BOE. And it feels like what that scenario looks like is quite different.
Absolutely, Alex. And, you know, I think the worry with that sort of strategy is, again, kind of deploying tighter monetary policy via rates on the one hand, but then almost kind of destroying your own case by doing the QE on the other hand. And so it really is a question for policymakers to ponder, and I'm sure they are at the moment, is where does it actually leave monetary policy net-net? And does that actually achieve the goal of tightening financial conditions enough so that your inflation level comes down without harming growth too much? I mean, it's a very tricky balance. I'm not sure that anyone's got it exactly correct, but something for us all to watch.
Yeah, definitely looking forward to it. Guys, thanks a lot. We really appreciate the time today. It's going to be a really interesting, well, lots of days. Christina Aquino, Michael Mickey from Bloomberg, thank you very much. We got some breaking news for you right now. Ray Dalio is now ceding title and voting rights to seal Bridgewater's succession plan. Bloomberg's Eric Schatzker joins us now on set to break it down for us. Eric, this has been like a really long time coming.
That is absolutely true, Alex. Ray Dalio has been trying to pave the way for succession at the firm he founded, Bridgewater Associates, for a dozen years, and now he's finally letting go. Things are in place, let's put it that way. Bridgewater has a board, including outsiders and insiders. Bridgewater has co-CEOs, and Ray Dalio has reached the point where he's satisfied that he can entrust the firm's future to this new cohort of leadership, give up his voting rights, which I have to add is an awfully big deal, and begin the next chapter of his life.
So what does this mean for Bridgewater? Just walk us through how this changes the shape, direction of the business going forward. As Alex said, this has been a long time coming, but now it's a reality, Eric. Just lay out for us what Bridgewater is going to look like going forward.
Sure, and that is such an important question, Guy. As Nir Bardea, one of Bridgewater's co-CEOs, put it to me, Ray no longer has the final word. That is the biggest indication of changes to come at Bridgewater, because as somebody who previously held 95% of the voting rights, it was ultimately Ray's decision, no matter whether they had an operating committee, no matter whether they had a board, no matter whether they had co-CEOs and co-CIOs, it was Ray's decision. And so Bardea, the co-CEO, and one of Ray's erstwhile co-CIOs, Greg Jensen, told me the firm is likely to invest more heavily and more aggressively in talent acquisition and also in technology. And as you and I both know, Guy, technology is something of an arms race in the hedge fund world. And if they perceive that Bridgewater has been falling behind, you know they're going to double down on those technology investments to try to get the firm ahead of its competitors.
I just feel like switching gears at firms this big and this well-known has been very difficult. And I realize I'm speaking more of private equity, for example, but nonetheless, they're not without major hiccups.
No, indeed. Look at what is happening before our eyes, what's playing out right now at Carlyle. Right? Bill Conway, one of the firm's co-founders, along with David Rubenstein, has stepped back into the interim CEO role because they decided they weren't happy with Kyu-Song Lee. Succession is tough.
Yeah.
Succession is particularly tough at a founder-led firm, and there aren't very many places that have done it well. In fact, in the hedge fund industry, it's much more common to see a founder like Dalio convert the firm into a family office or just shut it down altogether and retire. succession of this nature, where you're taking a firm that has $150 billion in assets and in effect turning it into an institution that will outlive you, is rare. Very few examples of it at all, and certainly nothing of Bridgewater's size, because it is and has been for many years the world's largest hedge fund.
It's going to be really interesting to see how this winds up playing out in the execution there. Eric, thanks a lot. Great breaking news for us there. Bloomberg's Eric Schatzker. Thank you for joining us. All right, let's turn back to the market here. Veteran Ed Yardeni yesterday said that the Fed should stop its tightening campaign after one more interest rate hike in November.
I'm totally stumped, mystified, surprised that Fed officials don't seem to acknowledge that just focusing on the Fed funds rate as part of the monetary tightening cycle is a mistake when you also have QT2 and you have a soaring dollar. I mean, these are very restrictive monetary developments. I think they got one more rate hike coming in early November, and that'll be it, because the financial stability issue will pop up as primary concern.
All right, turning back to our question of the day, is this the one where the Fed pivots? Joining us now to discuss is Goldman Sachs Chief U.S. Equity Strategist David Kostin. David, our question is really a reference to Friends, but the idea is that the Fed's going to have to pivot at some point because of financial stability concerns, and when that may be and what that means for the market. What's your take?
Well, the take at Goldman Sachs would be that the Fed is in the process of tightening financial conditions. And there are a number of components to that. You've been emphasizing the Fed funds rate, which is certainly a decision, but there's also the level of the 10-year bond yield. There is credit spreads. There's the dollar. There are equity prices. All of these are contributors to a measure of financial conditions, and the idea of tightening financial conditions would incline ourselves from a strategy point of view to focus on higher quality stocks, and we can define higher quality companies in the context of stronger balance sheets, less variability in their growth rates, a higher return on equity, a return on capital, less drawdown risk over time. These are some of the attributes that, historically speaking, Alex, have tended to outperform. Companies with these attributes have tended to outperform in environments with tightening financial conditions, which I think characterizes the financial environment that we're in right now.
David, were the Fed to pivot, though, how different would that list look like? What kind of stocks, what kind of assets would you want to own in an environment where the Fed is pivoting?
Well, God, it's a question sort of hypothetical, which is, if they were to do so, what are the impetuses? What would prompt the Fed to do such a thing? Well, it might be that the economy has slowed to a certain degree, such that there's concern about tipping in a recession. It's not the baseline view here. In terms of, well, what companies would do better then? Well, some of the much more defensive-oriented companies, value in particular, would come to the fore. Thinking about that as an attribute as opposed to growth. On the other hand, if the idea of the Fed's pivoting and rates are falling, that could benefit some on the growth side. So think about it as a balanced portfolio. Mm-hmm. What would be the reasons for it? I think becomes the critical question. And it's to underscore the fact that it is not the view here that the Fed is likely to be pivoting anytime soon. And given their dot plots and the commentary, my colleagues in economics tend to focus on that more than I do. But certainly it's highly relevant to the equity market, no doubt.
Yeah, absolutely. And you guys, taking a look at your view in particular, you have 4,000 on the S&P for next year in a soft landing scenario. You have 3150 in a recession. In a 3150, what's your base? Like, what does the recession then look like, and how do you manage that risk?
Well, to be very clear, let's lay out some of the path for both of these. So in the baseline expectation is that the Fed is able to manage a soft landing. So there's a narrow path to a soft landing. And what would that would involve? The economy slowing, the labor market slowing, and inflation, most importantly, coming down. And to the extent that that happens, the economy continues to grow. And that would basically be consistent with some of the higher quality stocks continuing to do better. And that would sort of be the baseline forecast. And Alex, you want to think about the level of the S&P 500 at the end of this year, somewhere around 3,600. That would be the building blocks behind a story of around 8% earnings growth this year, decelerating to around 3% earnings growth in 2023. And the idea of a decelerating economy, a decelerating earnings growth, but still positive, that would be consistent with a multiple of the market somewhere in the 15 or so times multiple range, and that's the expectation, and I would say that's most probable. To the extent that their investor community is pivoting, if you want to use that term as your word of the day, pivoting towards a likely recession, and there would be much greater concern. Market would be trading, in our view, something towards the bottom end, say 3,400 at the end of this year, and ultimately, as you indicate, troughing sometime sort of middle part of next year at the trough around 3,150, and that would be consistent, importantly, with the rate market moving a lot lower, and the idea of real rates, which started this year at around negative 1%. A couple of days ago, it was positive 160 basis points, and that pulled back to around positive 130 basis points. So the rate market has been, critical in terms of assessing the level of equities, broadly speaking. But the idea of the end of this year, the next quarter, this quarter, fourth quarter here, we just started, sort of 34 to 3,600 would be the kind of bid-ask range around where we trade, with the idea of the economy slowing, inflation perhaps coming down slightly, and the idea of the earnings slowing as well.
What's the tail risk multiple on the downside for the market, David?
Tail risk, I would say, would be around 14 times. Would be if you want to think about it as a level. That's not necessarily how we kind of arrive at that. We want to think about that in terms of risk premium models, things like that. But answer your question, probably around 14 times, and that's kind of where we would see it. The market valuation this year has gone from 21 times at the start of the year to around 15 times where we are today.
Yeah. So, David, what kind of profit margin world does that imply?
Well, I think you're setting up the most important development here, which is the big shock to the investment community, both macro and micro, was the CPI reading last month, when the expectation was it would continue to come down, and in fact, it moved the other direction. I think the analog to that in the public equity markets is the third quarter earnings season, which will be coming up, kick off around the 14th of October or so. And the expectations right now are for around plus 4% on the earnings front, year-over-year growth plus 4%. That would be benefiting, if you will, from the energy sector. If you take that away, earnings will be down by around 2%. And coming now to the specifics on the question of margins, the idea of margins declining this quarter is going to be the first time we've seen that in terms of my expectations, and that's likely to continue into next year. Expectations margins will fall next year from around 12.25% this year to maybe 12% next year, and the expectations from the market in terms of the consensus is that margins will expand by around 15 basis points, and that gap of around 40 basis points is the difference between earnings growth of somewhere plus 3 versus plus 7. I think that's the bid-ask debate in the market discussions that I have right now with clients.
David, are you surprised how fully invested the market still is into equities, both retail and institutional?
So the data that we look at, guys, shows something slightly different. We've seen that for the last 31 weeks consecutively that the investor community has been below average, and we want to think about positioning across mutual funds, households, pension funds, institutional investors, retirement funds, showing that that's actually below the average, if you will, somewhat modestly invested. You can think about that in terms of the hedge fund community here. The idea of net leverage has come down by 20 percentage points from like 85 to 65% net leverage. That's actually quite low. The cash positions in equity mutual funds are elevated. So those are all indications of relatively more cautious positioning on the part of most portfolio managers.
We'll leave it there. David, it's always great to get an update. Thank you very much indeed. David Kostin, Goldman Sachs Chief U.S. Equity Strategist, joining us on a day when we're seeing a fairly significant bounce, certainly here in Europe. This is Bloomberg.
stay like Bloomberg.
Bad news, good news, potential Goldilocks kind of scenario for the markets. You got that JOLTS number showing that the labor market is loosening somewhat. You had job openings at the lowest since June 2021. What does the market do? Continues its rally. The S&P up 2.6%, the Nasdaq 100 up a whopping 3%. You have yields coming in lower and the dollar lower as well. That is magic and music to markets' ears. Remember, also, we were very oversold coming in to this month as well. We're going to get some technicals in just a moment. Also coming up, we're going to talk about the food crisis in the world with Alvaro Lario, International Fund for Agricultural Development President. This is Bloomberg. All right, we're about an hour into the U.S. trading session. Stocks really hanging on into that second day of rally here. Katie Greifeld is tracking the moves for us. Katie?
Alex, if you look at the board behind me, it is the perfect risk-on picture. You can see the S&P 500 higher by about 2.7%, the Nasdaq 100 even more so. A lot of those gains coming from Amazon. JP Morgan says it's their favorite internet stock. Then you look at the bond market. You have yields lower on the 10-year, not as low as yesterday, but still about a 5 basis point decline there. And the Bloomberg Dollar Index off by about 0.6%. Really, again, just a risk-on picture. And let's focus on the S&P 500 because right now it's only Tuesday, but so far this week this index is up 5.3%. And if that holds, that'll be the biggest two-day rally since about April 2020, I believe. So it's still early, but we'll see. Let's talk about yields though, because we did get a little bit of a question mark of whether this would hold earlier in the day. You're looking at two-year Treasury yields right here. You can see they just about got back to flat. Then they dropped a little bit more when we got that JOLTS data at 10 a.m. And let's talk about the JOLTS data, because we did get the biggest one-month drop in job openings since early in the pandemic. 1 million fewer jobs in August than the month prior. We know that the Fed has been ultra focused on that very hot labor market. Some signs of loosening. It seems like that's helping out the stock market a little bit today.
Absolutely, getting a massive rally over here. I think we can blame the Australians for starting all of this off, Katie, but it certainly seems to be rippling through global markets. Katie Greifeld on the markets, thank you very much indeed. Let's pivot back to the geopolitics as well, because that increasingly could be a factor in all of this. In Ukraine, President Volodymyr Zelensky has said that liberating settlements from Russian occupation is now the trend. So his forces are pressing further into the eastern part of Donetsk, that region, significantly though, and I think this is something that everybody needs to pay attention to. We are now starting to see some meaningful gains in the south as well, and that is going to be something that is going to put further pressure on the Russians and the government, and in particular the Russian forces in that region. Meanwhile, the Biden administration is set to announce another package of US weapons that are going to be sent ultimately to Ukraine. John Kirby at the National Security Council spoke on this subject to Bloomberg's David Weston about what to expect from this package.
We have yet more additional security assistance packages to come here, David. I think you'll see in the next few days yet another announcement. As you know, about a week or so ago, we announced yet another round of security assistance, and it did include additional HIMARS ammunition as well as howitzers and howitzer ammunition.
And the impact of that is now clear to see. The gains that are being made in the east are significant. The gains in the south are starting to stack up, and these are in regions that have been annexed. A huge blow to Putin and his government in Moscow. Anne-Marie Hordern joins us now from Washington. Anne-Marie, we're seeing big gains being made on the ground in Ukraine by Ukrainian forces supported by these NATO weapons. What are you hearing in Washington, though, about the risks and how they could potentially be growing as the Ukrainian forces make these gains? Are people getting worried that actually we could see a bigger response, a more aggressive response from Russia?
So I think there's really two things people are focused on. One is, of course, Putin, who said that he would not go and call up reservists. He actually is. And I think a lot of people are focused on exactly how many reservists the country is able to get. And Admiral Kirby there, speaking to David Weston yesterday, spoke about this in terms of exactly who are these reservists, what is the morale, how far have they been in terms of their training and that kind of timeline. And we heard from the defense minister of Russia, Shoigu, talking about that they have about 200,000. We should note 200,000 Russians is also the amount of Russians that have recently fled into neighboring Kazakhstan because they didn't want to go into the army. So you actually have more Russian men fleeing Russia than going into the army right now. So there's a question about that. How much more manpower can Russia rely on? Russia obviously has a much bigger population. The second is, of course, Putin obviously playing out loud to everyone in the world about the fact that he will do anything to defend Russia, including his recently what he would call annexed territories, which we should note the Kremlin also doesn't even know what they annexed. Talking to reporters on a call, Dmitry Peskov was saying how they need to discuss the borders. So they don't even know what their borders are right now. Obviously, this is as Ukraine is making gains into that territory. But the big question is whether or not Putin will feel so on the back foot that he will dig in further, which we've seen in the past, and then he would use tactical nuclear weapons. But at the moment, the U.S. isn't changing their nuclear posture.
So, Anne-Marie, is the sense that Western deterrent has been enough so far? And if not, like, what are the backup plans for that? Because as you point out, as Putin feels sort of pushed into a corner, that deterrent becomes even more and more important.
It does become more and more important. At the moment, though, the United States will not tell you what the consequences would be. They said they would be swift and severe consequences, and President Biden even looked into the camera recently saying, Mr. Putin, do not call this bluff. There would be swift and severe consequences if he was to go into the nuclear arsenal, but no U.S. official will discuss what that is. It's ambiguous for a reason. The second, of course, though, is that what Admiral Kirby said is that there's going to be even more ammunition, even more aid and supplies going to Ukraine. Reuters was talking about what this package could be, likely the HIMARS. This is something that the Ukrainian military likes. They find them useful, and that would be north of $600 million worth of this. So the aid, and we also know this on the heels of $12 billion that was added into the stopgap funding measure for Ukraine. So the aid from the United States, it is clear that that message, that will continue until there's an end to this war.
All right, Anne-Marie, thanks a lot. Really appreciate that update from D.C., Bloomberg's Anne-Marie Howard-Dern. So obviously, one of the big fallouts from all of this happens to be with the agricultural market. The war in Ukraine is driving a global food crisis to a totally different level, thanks to disruptions in grains, fertilizer flows, and of course, natural gas disruptions. Bloomberg speaking with an aide to Zelensky, saying that a Ukrainian grain deal talks continue. So what does this all mean? Alvaro Lario is International Fund for Agricultural Development president, and he joins us now. What is the short and medium-term effect of the war in Ukraine? From what I understand, crops were okay this season, but next season and the season after are huge question marks.
Thank you very much, and thank you for having us. So it's clear that in the short term, most of the conversations are being focused on the supply as well as on the prices, which is fair enough, and there's a number of solutions at the international community that are going on, especially led by the Secretary General and other heads of state. However, for the next planting season, it's very clear that all of the small-scale farmers cannot absorb the increases of prices in terms of fertilizers, in terms of food, in terms of the climate shocks. So the next harvest season is going to be really very, very tough.
What needs to be done to alleviate that? It is going to be tough. What help can be given?
So I think in the very short term, what's currently many of the developments vis-a-vis agreements, how to get the grain out, how to get fertilizers out, are very important. For the next 2-3 years, if we do not want to come back to the same crisis over and over, we already had one in 2007 and a number of them since then on the food crisis. What we need is actually to invest on the distribution, on the storage, making sure that there's much more of local productions of many of the developing economies and also the low-income countries, access to fertilizers locally.
Alvaro, it looks like we might have had a technical disruption. While we try and get it back, Guy, I think the also interesting point too is the whole natural gas implication for fertilizer, right? As natural gas becomes so expensive, you can't run your fertilizer plant to make the fertilizer, and that of course is going to drive up costs for farmers, so then they're going to plant less too. So there's a huge kind of ripple effect there. Alvaro, back with us. Alvaro, talk about the fertilizer/natural gas impact.
So I would say right now we are both in an energy crisis and also in a cost of living crisis as well as a climate crisis. So on top of the fertilizers, what I also wanted to bring forward, for example, is the current floodings that we have seen in Pakistan. It has a massive impact in terms of rice production. As an example, Pakistan is the 4th biggest production of rice, and that has meant also that there have been some export bans. So also the climate shocks are very important, and to be aware that they have spillover effects. In terms of the fertilizer, my main point would be that many of the low-income countries, actually they have those fertilizers being produced locally, but they are tied up to long-term contracts that have been exporting many of these fertilizers. A lot of leaders are looking right now into how they can also keep those fertilizers on the ground.
Alvaro, can we just talk a little bit about what is happening with the grain deal that was done with Russia to get Ukrainian grain to international markets? What is your sense of how that is working right now? Aside from the risk of the whole deal being pulled, do you continue to see it working right the way through the winter and into next year? Is this now the benchmark that you think we are going to be seeing Ukrainian grain exports operating under?
So the international community, we were recently at the General Assembly in the UN. There were a number of leaders, the US, France. We were looking out to how to actually make that happen, where it would be the Baltic, where it would be through transport on the ground. But I think that will happen. I'm very hopeful it will happen. Now the issue is to make sure that also fertilizers We managed to get them out of Russia and of other countries so that they can also, the flow and the supply continues, that there are no sanctions associated. So there's a lot of coordination. I can confirm that there's a number of leaders in the international community who are coming together. However, most of the harvest season for the next year is going to be lost. And we need to put in place financing mechanisms to make sure that the small, poor farm holders can also survive for next year.
Losing a whole year of harvest, that is significant. When you look globally then, what grain is the most at risk when you pair sort of climate change with the war in Ukraine?
So I would say that generally we have been seeing shocks everywhere. That's one of the issues in the Horn of Africa, in the Middle East. So it's not only one issue, as I was mentioning, Pakistan. I think it's the number of spillovers. The climate crisis is making that many of the smaller farm holders actually they're having to sell their assets, to sell their land in order to get food. That obviously has repercussions in terms of the planting season. They cannot afford right now the fertilizers. They cannot afford the fuel. So it's looking bad. So we really need to have a coordinated effort to make sure that we do not leave them behind.
Alvaro, final question from me. Are we going to see food inflation lasting for many, many years? Is it going to be something that we're all going to have to get used to?
So that's a very important question. I would say that from the peak, a lot of the food prices have been coming down. What we need to make sure is that the supply and how the different supply chains are works for everybody, for the bigger firms as well as for the small farm holders. It's very difficult to predict, but clearly the tension will continue over the next year.
Yeah, it feels like that's a possible yes to your question, Guy. Alvaro, we appreciate your time today and the work that you do. Thank you, Alvaro Lario, International Fund for Agricultural Development President. All right, coming up, John Kolovos is Macro Risk Advisors Chief Technical Strategist, and he's going to join us on what he's seeing in this market. Obviously, we're seeing a nice oversold bounce over the next 2 days. How many more legs does it have? This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Ruchika Gupta. In Ukraine, President Volodymyr Zelensky said that liberating settlements from Russian occupation is now the trend. His forces have pressed further into the eastern Donetsk region and seek gains in the south. Meanwhile, the Biden administration will announce another package of U.S. weapons within days. Bloomberg's learned that the UK sees the prospect of a deal with the EU on Northern Ireland's trade arrangement within months. People familiar with the matter tell us the government has softened its approach, and that's led to a significant shift in the dynamic over the past month. That could finally draw a line under Brexit negotiations more than 6 years after the UK voted to leave the EU. And former Meta Platforms Chief Operating Officer Sheryl Sandberg is donating $3 million to the ACLU for the fight for abortion rights. The organization says Sandberg's donation will give it a running start against state anti-abortion efforts spurred by the Supreme Court's overturning of Roe v. Wade. Bloomberg estimates Sandberg is worth $2.1 billion. Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ruchika Gupta. This is Bloomberg. Alex.
All right, Ritika, thanks very much. All right, back to the markets here. The S&P up almost 5% in 2 days. We're up by 2.6%. So what are the technical signals right now? We were oversold. Are we approaching overbought? What do you do? John Kolovos, Macro Risk Advisors, Chief Technical Strategist, joins us now. John, like I just mentioned, we were very oversold. Is this just an oversold bounce, or are we in overbought territory now?
Thanks for having me. Are we in overbought territory yet? No, not yet. But the trend is still down decisively for the S&P 500. Really, at the end of the day, what I need to see the S&P start to build value somewhere north of 4,100 to start to feel better about whether or not this is counter trend or not. But like you said, we were oversold, sentiment, apocalyptic. And on top of it, we do have bullish cycles that are coming into play that we should at least be open-minded to the fact that this market could rally a little bit more.
So, John, just walk me through the possibility of while a market that is big picture going down, getting some really big counter-trend rallies. How big could they be? What are you looking for this one? I'm just curious about how tradable this market is.
Right. Well, what I've been telling my clients over the past couple of months is that we are in a technical torture chamber and that we're going to see massive swings in both directions. So upside, hey, if you look back in 2008, even most recently, these rallies can be 15, 20% to the upside, right? And there's no reason why we couldn't expect that again now. But what I think is important for your viewers and for my clients when I talk to them is that when trend is down, the odds of a left tail event are greatest. So we still need to see the S&P get back above something like its 200-day moving average, which is somewhere around 41 to 4,200 on the S&P.
Just some breaking news for everybody. According to some delegates, OPEC Plus is considering a cut of their quota of as much as 2 million barrels of oil a day. They're meeting in person on Wednesday. Considering that a lot of the countries aren't able to produce their quota, you'd look at least 1.5 million barrels a day is what I'm hearing is what you'd need to see some kind of real cut in the market. Potentially now, we're looking at 2. Hey, John, to continue the conversation and moving to yields for a second, obviously lower rates is going to mean higher equities. Do we retest the 1.5 level for the 10-year? What do you think happens there?
We could see the decline down that low. I think the main level for the 10-year to keep an eye on is 3.5% on the 10-year rate. You got to get underneath 3.5%. That should open a move up to around 3.25 or so. But I think what's mostly important for the interest rates in general is that the implied volatility, if you look at the MOVE index, right, it's still elevated and it's very high. And that to me tells me that macro uncertainty is just too high. And when that happens, you want to side with the prevailing trends, not fight them too much. And unfortunately, the prevailing trends are risk off.
What does that mean for the dollar? I've had a lot of chat over the last few days. The dollar may be peaking.
Yeah, well, I brought a chart. I don't know if you guys have it, but a chart that I used a couple of weeks ago with you, and to show that the dollar is very extended, not just in the near term since 21, but since 2008 as well. It's put in a nice sequence of a 5-of-5 wave rally, and When it got to 114, that's when we need to be on alert for it to roll over. So it is quite possible that the dollar is putting in a major peak here. What I need to see to confirm that would be a move under 108 to 107. You do that, then I would say that a major decline for the dollar is coming, and then of course that would be very good for risk assets.
Hey, John, last question. We're obviously all looking ahead to Jobs Friday. What kind of catalyst would that be in the market? Like, how coiled is the market, or how spread out is the market?
That's interesting because we're already getting the rally right now, right? We're already up 5%. So I would almost guess from a tactical standpoint, by the time we get there, if we're already still in rally mode by then, and maybe an opportunity to sell and take profits at that. It'd be a lot different if we're going to the job numbers and we were oversold, right? And then you get that coiled spring. I just feel as though that if we get there and we're still elevated and we haven't pulled back, maybe if we're down to 3,700 to 3,650 on the S&P come Friday, then maybe that would be a good buying opportunity for an extension of this rally. But if we're overbought come Friday, I think you got to be careful with that number, regardless of what the outcome is.
Always great to catch up, John. Thank you very much indeed. Technical torture chamber, that's going to stick. Thank you very much indeed. John Kovalos of Macro Risk Advisors, greatly appreciated your input into this. Alex, what I've taken for the last couple of days, though, is that this is a market that is desperate for a pivot from the Fed. It really wants to go higher. It may be a short-term bounce, but it just shows you that that instinct is still there.
And also, that in some ways markets are continually supported by central bankers of some type, and that brings me back to the OPEC plus headline. I mean, the narrative is that OPEC wants oil above 90. Looks like they're going to try and get there, even if it's a 2 million barrel a day cut, and that has to support risk assets to some extent.
Well, yes and no. You could argue that if they keep prices elevated or force prices back up again, that's going to feed back into the inflation narrative, which in theory should be negative from a Fed point of view, i.e. they have to continue to fight that inflation story. So I can't remember who was pointing this out a little bit earlier on. Are the fact that commodities have come down an indication that the Fed policy is working? And if so, would a rally back from that indicate that the Fed needs to do more?
Right. Yeah, but
I think it's a really tricky one.
But I think what the key is they're going to watch to OPEC is the band. Like if it's a 90 to 100, it's a tight band, and it seems like they definitely want to manage that price to some extent. Anyway, oil up by about 3% on the news. This is Bloomberg.
So we're coming to the end of the day here in Europe. Time probably to join some dots. It kind of all started yesterday, I think, with the ISM, but actually with the Australians only doing 25 basis points at the RBA. The market was expecting 50. You get big moves in the Australian 2-year, which then it goes into the European story. You can get a big move in the UK 2-year. I don't think this has got anything to do with what's happening in the UK right now. You look at what the Conservative Party conference is delivering up in Birmingham. U-turn after U-turn after U-turn. We'll get to that story in just a moment. What it has meant, though, is a big pop in equities that continues, that takes us north of 400 on the stock 600. We're trading at 401.45. Is this a short squeeze? Is this sustainable? Is this something else? We're going to try and answer that question. Dan Morris, BNP Paribas Chief Market Strategist, will be joining us in the next hour to try and figure out what is happening here. The close is next. This is Bloomberg.